Greetings, everybody. Welcome to Liberty Call. Today is Thursday, October 19th, 2023. Hope everybody's having a good day out there in the interwebs. It's a beautiful day here in Colorado. Trees are turning brown from an orange and all the good colors here of the fall time. So anyways, and I'm a little greasy and dirty. I had to replace the batteries in my truck today. That was a lot of fun, and got to go to AutoZone, dump oil, and all sorts of fun things earlier this afternoon. So that's all fixed. Now I just got to change the oil in both cars before the ground gets too cold, because laying on the cold asphalt is not fun. Anyways, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, give me some thumbs up, likes, shares, subscribes, follows, hit the notification bell so you know when we go live. Let's go ahead and get into the numbers for today. More angry markets, unfortunately, but that is just the situation that we've put ourselves in. The Dow Jones was down 0.75%, 250 points, closed at 33,414. S&P 500 was down 0.86%, closed at 4277. NASDAQ down 0.96%, closed at 13,186. All three of these were in they started out in the red, and then they went into the green, and they went back in the red. It was just back and forth all day long, and really lost a lot of steam here in the afternoons. The VIX was up 11.34% today. It's at 2140. So for anyone out there who doesn't really understand how the VIX works, in simple terms, in my view, anything below 20 is kind of your green light. From 20 to 30 is your yellow light. Proceed with caution. And anything over 30 on the VIX is red light. Stop, look both ways. If you do decide to go, you're on your own. All right. Canada was down 0.52%. Brazil was up 0.17%, and Mexico was down 0.95%. Western Europe, Germany was down a third. UK was down 1.17%. France was down 0.64%. Netherlands down 0.27%. Spain down 0.72%. Italy down 1.38%. Switzerland down 2.13%, and Portugal down 0.58%. Russian exchanges both green again today. MOEX up 0.18, RTSI up 0.51. And the overnights, the Nikkei in Japan was down 1.86, Australia down 1.36, New Zealand down 0.98, the Shanghai in China was down 1.74, the Shenzhen Component down 1.65, China A50 down 2.79, DJ Shanghai down 1.69, Hang Seng down 2.94%, and it looks like the Taiwan weighted was closed. All right. So like I said, angry markets out there, folks. So if you haven't already started, prepping, getting your prep kit ready and, heading towards the lifeboats or putting the sandbags around your world, now's the time to do it, folks. All right. Let's get to the market recap for today. Wall Street falls as investors weigh Powell remarks. Tesla shares sink. Uh-oh. All right, let's see what's going on here. Come on. All right. On Thursday, U.S. stocks experienced a decline marked by significant volatility, primarily triggered by U.S. investors' reactions to comments made by Federal Reserve Chair Jerome Powell. One major player, Tesla, saw its shares plummet by around 10% due to a series of disappointing results and concerns raised by CEO Elon Musk. Tesla's third quarter performance failed to meet Wall Street expectations, particularly in terms of gross margin, profit, and revenue. Musk further exacerbated the situation by expressing worries about the impact of high interest rates on consumer demand. That's a serious worry. I mean, I don't know why that would spook the market. I mean, it's kind of common knowledge at this point. Amidst this turmoil, Treasury yields continued to surge, with the 10-year yield approaching 5%. Jerome Powell, during his speech at the Economic Club in New York, indicated that the U.S. Central Bank was cautiously navigating its monetary policy following a string of aggressive rate hikes last year. However, he noted that the robustness of the economy and the persistence of tight labor markets could necessitate further rate hikes. In English, he doesn't have a clue what's going on. He's just trying to figure it out as he goes. Michael James, managing director of equity trading at Wedbush Securities, commented, quote, "I don't think he's unmuddied the water so much," end quote, highlighting the uncertainty surrounding the future direction of interest rates. I imagine they're probably going to go up at least once. I wouldn't be shocked if they did 2 rate hikes this month and December. All right. On a different note, Netflix witnessed a surge in its shares. The streaming giant, the world's largest by subscriber count, announced plans to raise prices for some of its service tiers in the United States, Britain, and France. This decision followed the addition of 9 million users during the third quarter. How many did you lose because people were their password, they got cut off and had to, they just gave up on using it. All right, where were we? The broader market was characterized by a higher number of declining stocks compared to advancing ones, with the ratio of 2.86 to 1 on the New York Stock Exchange and 2.21 to 1 on the NASDAQ. In terms of 52-week highs and lows, the S&P 500 saw 2 new highs, 31 new lows, while the NASDAQ Composite recorded 13 new highs and 309 new lows, underscoring the turbulence within the market. It's bumpy out there, folks. Again, get your life preservers on because it could get much worse. I've been through this before, 2007 and 8. It was a bumpy ride. All right, next up, got some jobs data. U.S. weekly jobs claims at 9-month low. Labor market remains tight. All right, the number of Americans filing new claims for unemployment benefits reached a 9-month low last week, indicating the persistence of strong job growth in October and a tight labor market. The unexpected drop in initial jobless claims reported by the Labor Department reinforced the impression of sustained economic momentum. Solid retail sales and factory production for data for September, coupled with this decline in jobless claims, have bolstered expectations that the Federal Reserve might keep rates at higher levels for a longer duration. Again, this is not shocking news. But every time these financial journalists type it, they always seem like, oh my God, they're going to keep rates up. Shocking. The Federal Reserve Chair, Jerome Powell, delivered a speech in New York indicating that the U.S. Central Bank, our bankers, are proceeding cautiously with policy decisions. Despite the aggressive rate hikes last year, Powell mentioned the strength of the economy and ongoing tight labor markets as factors that could warrant further rate increases. The strong economic data and soaring U.S. Treasury yields are leading financial markets to anticipate the continuation of higher interest rates. The yield on the 10-year Treasury note is nearing 5%. And I believe last night, the yields on the 10 and the 30 tipped over 5% for the first time I've seen in a while. So, those rates are going up. The yield on the 10-year, 5%, a level not seen since just before the financial crisis in 2007. Meanwhile, despite these rising interest rates, the labor market remains robust, driving consumer spending and overall economic performance, which has led to elevated inflation. And well, the elevated inflation is due to the monetary printing 3 summers ago. That's the key driver, in my opinion. The economy is expected to have grown at its fastest pace since late 2021 in the third quarter. While the broader economy is resilient in the face of higher interest rates, the housing market continues to struggle with surging mortgage rates and limited supply reducing affordability. Existing home sales dropped to their lowest level since October of 2010, largely impacting first-time buyers. In a separate report, business conditions in the Mid-Atlantic region remained subdued in October, with manufacturers expecting an improvement over the next 6 months. The labor market's health in October will be further clarified by data on the number of people receiving benefits after an initial week of aid, which serves as a proxy for hiring. Continuing claims increased but remained at relatively low levels. So good news on the job front. Not good for if you're wanting interest rates to go down, but in my opinion, they're kind of normal at this point. They're not really high, they're not really low, they're just kind of medium. All right, one last article here from Zero Hedge. It's titled "Peter Schiff, the Unsinkable American Consumer is Drowning in Debt." And I actually listened to this podcast yesterday or this morning, I forget which, but this is an article based on that. All right. Peter Schiff, in a recent podcast, pointed out that while retail sales may seem robust, they don't necessarily reflect a strong economy. The latest retail sales data for September was reported as stronger than expected, with a 0.7% increase, exceeding the 0.3% gain expected. Year over year, retail sales were up 3.8%. However, Peter argues that these numbers are misleading. First, retail sales is not adjusted for inflation. In a climate where prices for most goods and services are increasing, the raw retail sales number tends to rise because consumers are paying more for the same or even fewer items. Your box of Cheerios, right now doesn't have the same Cheerios in it for the same price that you had 3 or 4 years ago. Where was I? The surge in restaurant sales serves as an example. While sales are up, the cost of dining out has significantly increased. People may not be eating out more, but they are paying more while they do. Peter emphasizes that this is not an indicator of a strong economy, but rather rising inflation. Furthermore, these sales are often driven by credit card debt. Revolving credit, primarily credit card debt, jumped by 13.9% in August, resulting in a total of $1.28 trillion in revolving credit owed by Americans. Peter points out that when you break down the categories of retail sales, it becomes evident that people are spending more on necessities like food, shelter, and energy, insurance, and healthcare. However, they have little left over for discretionary spending on other things they want. This dependence on credit cards to cover essentials reflects the economic strain on many Americans. In conclusion, Peter cautions against celebrating apparent consumer resilience, emphasizing that the economy's reliance on consumer spending, driven by increasing debt and surging prices for essentials, is a concerning economic trend rather than a sign of strength. And I would agree with that wholeheartedly. In client meetings recently, pointing out the consumer spending numbers, while they look good on paper, I don't know anyone who has said, no, Ray, everything is cheaper now than it was in the fall of 2019. So I have yet to hear anyone say that. Most people are complaining that everything's more expensive and money's really tight, even when we're doing pretty good. So. Anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.